Hey everyone, welcome back to another recap podcast from SNXweave, where we give quick weekly recaps of news and important updates from the previous week from the Spartan Council and core contributors, as well as discuss what the Grants Council and ambassadors are up to, so let's get started. First off, it's election season again. Crazy how fast time flies. And in exciting news, this election will be the first to feature the brand new V3GM election module. Nominations opened last Friday and will close this Friday the 17th, after which voting will begin. Thanks to V3GM, nominations no longer happen in the Synthetics Discord. Check out the blog post Matt posted for an in-depth explanation of how to nominate yourself. And if you're running for Spartan Council this epic, be sure to also be on the lookout for details about the Spartan Council election panel hosted by SNXweave. Now on to regular news updates. The SAFE release has gone out and included 3 SIPs. The first was SIP 235 to update the issuer modifier. This SIP increases security for future synthetics deployments for the only trusted minters modifier in issuer. Next was SIP 238 to only allow token transfers via proxies. This SIP allows users to interact with SNX as well as synths via their proxies and stops allowing transfers via their implementations. By restricting transfers to proxy only, this SIP mitigates possible counting issues in protocols that use synthetics tokens. And last was SIP 240 to update the liquidate amount. This SIP ensures that the correct amount of debt is liquidated for accounts with mostly escrowed SNX. SAFE went out last Thursday, wrapping up the last of the most recent urgent V2X fixes. During their meeting last week, the Spartan Council also discussed SIP 244 for the new inflation mechanism. Written by JVK and Daniel, this SIP proposes reducing inflationary SNX staking rewards by 1% each week until the target of 20% yearly inflation is reached. A number of council members brought up concerns that the inflationary rewards are getting to be a bit too high. The target staking ratio SIP was originally implemented with the hope that it would attract more stakers, but the protocol seems to have reached a local plateau in terms of the number of users willing to stake. Based on the current rewards, the yearly inflation amount is about 45 to 50%. Daniel said that while there seems to be mixed viewpoints from the community on this issue, many do believe that inflation needs to come down. KSET brought up that such an abrupt change could create issues, and Afif suggested possibly lowering it incrementally. The SIP has been rejected with 6 votes against. The council also discussed core contributors on DAOs, with Calavera asking if there are any rules about CCs being on councils or committees. Daniel confirmed that there are no rules against it, but pointed out the additional time commitment it takes to serve on any of the councils. Calavera suggested that he might write a SIP in the future, limiting the number of CCs on any given DAO, but Daniel responded with a previous argument that the token holders can and should be trusted to make those decisions when they vote. Lastly, it was brought up that 1inch just integrated with Synthetics atomic swaps, which resulted in a $40 to $60 million daily volume increase. Caleb said they've been available for a while, but it was only recently that we were able to take full advantage of them. Adding 4x increased usage, but the 1inch integration added to that even further. More integrations are likely to happen in the future. This has also had a very positive impact on the ETH skew, which was the issue that inspired the proposal of the die wrapper SIP during the previous epic. The current skew is 50% long ETH. There were also a few SIPs presented last week, so let's discuss them briefly. First was SIP 247 to set up the new WETH wrapper. This SIP, presented by Caleb, proposes creating a WETH wrapper with a mint and burn fee rate of 5 basis points and a max token amount of 5,000 ETH. This aims to create more flexibility by allowing an unwind with a negative burn fee rate. The issue is that the supply of SETH in curve pools is shrinking, meaning this could potentially create a premium on SETH. The depletion of the curve pool synths also affects the usability of atomic swaps. Next up was SIP 300, which was an overview of V3. In a separate call, Afif presented SIP 300, the first of the Synthetics V3 SIPs. V3 aims to rebuild Synthetics as a more versatile protocol on efficient contract architecture, while also alleviating the pain points of V2X. This first SIP is basically a summary of all things in V3, mostly covering the new proxy architecture and new debt pool structure. Fief explained that the differentiated debt pool would add flexibility and modularity to the staking process by allowing stakers to choose exactly how they delegate their credit, even down to the individual synths and products. Fief said the obvious solution to this is to create a siloed debt pool for each market, but the downside is you fragment liquidity, and we don't want that. The power of Synthetics is liquidity, and without it, it's not super useful anymore. This is where SIP 303 comes in. This SIP proposes the creation of markets in V3, which are expected to accept SUSD, generate positions, and rely on liquidity provided by funds to back any debt inflation generated by their positions. Fief explained that SIP 303 basically takes the protocol and separates it into a bunch of individual markets, spots, futures, etc. Lastly, he discussed SIP 302 for funds, which is not quite the decided name yet. Funds can be created by anyone and serve as an intermediary by accepting collateral from accounts and providing liquidity to markets. The Spartan Council Fund will be the only one initially, and it will continue to choose all of the governance-approved assets. Fief assured everyone, however, that this does not fragment liquidity any more than the current V2X design. In Grants Council updates, the team had a call with the Universe XYZ team to reconfirm that expectations are aligned on both sides. They're currently focusing on delivering the designs and will be helping with the mint contract. Trading will happen on Quixotic, and the team will be reaching out to them to coordinate this. The council is also still deciding on the lore portion of the project. Next, some of the tool site icons have been updated based on what designer Jade has completed. And lastly, the team is working with the devs interested in working on the Wrapper UI project. A core contributor will have to review the code before this is deployed, however. In Ambassador Council updates, the ambassadors hosted another Spartan Space last week, this time with D-Hedge and Tauros, where we got to hear from Jake, Matt, and Jakey. Jake is the head of growth and marketing, Matt is a community manager, and Jakey is a core contributor on the contracts team at D-Hedge. For some background, D-Hedge is an asset management platform that launched in August of 2020 with very close ties to Synthetics. They currently have 1,300 funds on the platform, managed by 1,000 manager wallets. Tauros is an incubated protocol that D-Hedge launched this past February. More specifically, it's a protocol that's structured for automated strategies, which ties in very nicely with D-Hedge's fund service. Tauros currently offers the following products: 1x, 2x, and 3x bull and bear funds on Polygon for Bitcoin and Ethereum, managed liquidity services, stablecoin yield products, and the most recent addition, SNX. All of the guests were very excited to talk about the product they launched the day of the Spartan Space call. D-Hedge and Tauros enabled a one-click debt hedging tool on Optimism. Now, each staker can hedge their exposure to the debt pool. This tool helps automate SNX stakers' debt management by automatically mirroring the debt pool on Optimism. The D-Hedge Debt Mirror Index token, SNX, was initially launched on Ethereum mainnet, but is now on Optimism as well. When asked what the future of this looks like, Jakey said Aave is currently the best market for this strategy, but if there were a better market, they would farm on that one as well. It's currently a free service, however they've been playing with the idea of possibly adding a fee if users were interested in a product that included some yield rather than being strictly a hedge. The ambassadors also asked how the other funds have been performing, and the guests replied saying a lot of the pools were performing better last year but have obviously dropped off in the bear market. They added that they've seen a lot of pools migrate from mainnet to Optimism, and the ones that have done so lost their public track record that was available on L1. The team, however, is looking at a way to be able to transfer that over. Lastly, when asked how the process of adding whitelisted protocols work, Jakey explained that they first look for protocols that add utility, then for those that are seeing healthy adoption, and finally they consider the complexity of a possible integration. D-Hedge promises just-in-time liquidity, so users have to be able to access their funds on demand. So anything that requires a lockup or cooldown period is an automatic no-go. All of these factors are considered in the governance process that ultimately makes up the decision of what protocols get whitelisted. And that's it for today's updates. Be sure to check out our weekly recap blog post, share this podcast link, and let us know what you think and what you'd like to hear more about from SNXweave. Thanks for listening.